Hello everyone, hope you're all doing well. This is the last video on Section 6, Withholding Taxes, and I hope that you got a chance to go over Part 1, 2 and the review video for Section 6. If you have any questions and you want me to go over anything in more detail, please leave me a comment and I will definitely get back to you. Having said that, let's dig into today's video. And the topic is supplemental wages, backup withholding, and withholding from pensions and annuities. So let's get started. Let's first look at supplemental wages. An employee's pay may consist of regular wages and supplemental wages. And in general, all wages that are not regular wages are supplemental wages. Let's see the difference between regular and supplemental wages. Regular wages are the amounts paid for payroll period either at a regular hourly rate, daily basis, or similar periodic rate, or in a predetermined fixed amount. And the wages that vary from payroll period to payroll period based on factors other than the amount of time worked are supplemental wages. Supplemental wages may be paid at same time as regular wages for the payroll period or at any other time without regard for a payroll period. And here are some examples of supplemental wages. Reported tips, overtime pay, bonus, back pay, commissions, non-qualified deferred compensation payments included in wages, non-cash fringe benefits, payments made under reimbursement or other expense allowance arrangements that are made under non-accountable plan. Sick pay paid by the third party as an agent of the employer. Amounts includable in gross income under IRC Section 409A. Income recognized on the exercise of non-statutory stock options. Wages imputed for health coverage of the non-dependent of an employee. Wages recognized on the lapse of restrictions on restricted property transferred from an employer to the employee. So these are all examples of supplemental wages. Are these supplemental wages taxed and how are the taxes calculated? There are two withholding methods available with respect to the payment of supplemental wages. Number 1, aggregate method, and 2, optional flat rate method. Let's have a look at the aggregate method first. Under this method, the employer calculates the amount of withholding due using the employee's current Form W-4 by aggregating the amount of supplemental wages with the regular wages and treating the aggregate as if it were a single wage payment for the regular payroll period. The employer must use the aggregate method if the optional rate method cannot be used. Now let's look at the optional flat rate method. Under this method, the employer disregards the amount of regular wages paid to an employee, as well as any withholding allowances claimed or additional withholding amount requested by the employee on his or her W-4. And the employer uses a flat percentage rate in calculating the amount of withholding. And there are two percentages. If the supplemental wages are less than 1 million, then the optional flat rate is 22%. And if the supplemental wages for the whole year are more than 1 million, then above 1 million, the optional flat rate is 37%. This method is available only if two conditions are met. Number 1, the employer has withheld income tax from the regular wages paid to the employee during the same year as the payment of the supplemental wages or during the preceding calendar year. Number 2, the supplemental wages are either not paid concurrently with the regular wages or stated separately on the pay stub. Let's look at one example. Here, Roger's bi-weekly wages are $1,200 and Roger wins $1,000 in contest sponsored by the employer. The employer combines the contest money and Roger's regular bi-weekly wage payment of $1,200 for the current payroll period for the total combined amount of $2,200. And they are shown on the pay stub as one aggregate amount. Because the employer does not indicate two types of payments separately on the pay stub, he will use the aggregate method and he will withhold as if Roger received regular bi-weekly wage payment of $2,200. Using any of the federal calculation method that he uses normally, like the percentage method and the wage bracket method, he will calculate federal income tax on total amount of $2,200. Had the employer paid or indicated supplemental contest income separately on the pay stub, then he would tax the contest income at 22% or 37% if the year-to-date supplemental wages paid were more than $1 million. The next topic is withholding on pensions and annuities. Generally, the distributions from employers' retirement or deferred compensation plan are subject to federal income tax withholding. Example, pensions, annuities, government plans, profit sharing plans, stock bonus plans, etc. The method of withholding from pension and annuities depend on the type of payment. Payment can be periodic or non-periodic. Periodic means made over a period of more than 1 year. So if the payment is periodic, then withhold federal income tax from periodic payments as if the payments were wages, using one of the allowable withholding methods. If the payments are non-periodic, then what? Then all non-periodic payments made that are not eligible for rollover to another qualified plan and are at least $200, they are subject to federal income tax at the rate of 10%. And non-periodic payments that are eligible rollover distributions are subject to mandatory federal income tax withholding at 20% unless the distribution is directly rolled over to another qualified plan. Whatever method is used, the amount of withholding cannot exceed the amount of money distributed plus the value of any property distributed. Also, no withholding is required if the distribution consists solely of the employer's securities and up to $200 in cash representing fractional shares. The recipients can use Form W4P to help determine their withholding. This form can be used to decline withholding altogether, to specify the marital status and the number of withholding allowances, or to ask for additional dollar amount to be withheld. Unlike the Form 2020 W4, the W4P has not been updated to account for the tax law changes that were made in the Tax Cut and Job Acts. So it retains the use of allowances. And if the recipient don't submit the Form W4P, then the default is married with 3 allowances. Next, let's talk about backup withholding. If the business make payment to any of the non-employees like independent contractors, lawyers, accountants, estates of deceased employees, and the payments are more than $600 for the year, or there are direct sales of $5,000 or more, then the employer may tax the payments at the higher rate of 24%, and that is called the backup withholding rate. The employer will withhold at this higher rate only if the payee fails to provide the payer with the TIN, Social Security number, individual tax identification number, or the EIN, that is the employer identification number, or provides one that is obviously incorrect. The payer is notified by the IRS that the TIN provided by the payee is incorrect, and the IRS sends the notice B to the payer. or the payer is notified by the IRS that the payee has underreported the interest or dividend payments, or the payer does not receive from the payee receiving interest or dividend payments a certification that the payee is not subject to withholding. Now let's look at some details regarding the B notice that the IRS sends. If the payer receives a B notice from the IRS, withholding must begin no later than the first payment after 30 days from receipt of the notice and will last until another TIN is properly furnished. Once the payer receives the B notice, the payer or the employer must send a copy of the B notice to the payee or the non-employee along with a form W-9, that is the request for tax identification number and certification, within 15 days, which the payee needs to complete, sign and return. And if properly completed, the form W-9 is returned by the payee before 30 days have passed since the payer receives the B notice, then backup withholding is not required. The next topic is advanced earned income credit. Employees may no longer obtain advance payment of the earned income credit and should not be submitting the form W-5 to their employers. Employers no longer are required to make the advance payments of the earned income credit. If the employee is not claiming exempt on W-4, but because the income is low, so there are no federal income tax on the wages, then the employers are required to notify the employees for the tax refund because of the earned income credit. The employers may provide notification by giving employees either the copy B of the form W-2, which has the instructions on the this EIC thing, or they can provide notice 797, that is possible federal tax refund due to earned income credit, or a written statement with the exact same wording as notice 797. The employers are encouraged to notify the employees whose wages for 2020 are less than 56,844 that may be eligible to claim earned income credit for 2020. The last topic on this video is Social Security and Medicare tax rates. We all know that Social Security rate is 6.2% and the employer matches. And the Social Security wage base for 2020 is 137,700, and for 2021 the wage base is 142,800. Medicare tax rate is 1.45% and the employer matches that. There is no wage base for Medicare. There is an additional 0.9% Medicare tax on the wages above 200,000. And this is only paid by the employee. The employer don't match additional Medicare tax. The additional Medicare tax withholding applies only to the wages paid to the employee that are in excess of $200,000 in the calendar year. So the employer may not withhold an extra 0.9 from the amount of the wages before the employee's wages reach 200,000. The next few slides are about the wages that are exempt from Social Security and Medicare taxes. Please review these slides. I think there are 3, and you may pause the video to stay on the slide for a longer time. And for me, I'm signing off for today, and that's all for section 6. I will see you next week with a new video that will cover more topics. So please stay tuned. Goodbye for now.